Well, good morning, and we have an interesting day today. A lot of news, so hang in there with me because, I've accumulated all this news. I've ferreted out what I think is important. That's what I do every single day, and today there's just a ton. And if you're interested in both Tesla and the economy, which I assume you are because you came here, we're going to really be able to ferret out where the economy really is right now and how things are headed. Now, top of the news, of course, is government shutdown is still potentially going to happen. The president and Congress did not come together yesterday, and among that conversation, the conversations after was that somehow Hakeem Jeffries said that the president of the United States is a really good listener. How is this news to him? I've reported on this many, many times right here. You've probably read other articles about it. Everybody that knows the president knows he's a good listener. How is it that Hakeem is just coming to this realization? It's shocking, ridiculous, dumb. Anyway, Tesla's down a little bit this morning. Seemingly, it looks like Tesla is just following the market, which is also down a little bit this morning. And when you listen to the news that I'm going to present to you this morning, I'm not sure you're going to be able to figure out why the market is down a little bit this morning. Interestingly, we are having a continuation of the bond rally. Thank you very much, Randy Kirk. Oh, by the way, now I don't have to tell you who I am later in the show, right? This is Randy Kirk, and we're going to be talking about Tesla here. First, though, the best news of the day, Elon says that Grokipedia is going to happen. He says Grokipedia will be a massive improvement over Wikipedia. He says that xAI is building Grokipedia, pitching it as a fix for Wikipedia's flaws in accuracy and neutrality. He says they will be building it with xAI, of course, and it will be a great way to understand the universe better. So you may or may not know it, but Wikipedia is massively biased. It's gotten worse over the years. And this is really, I'm very excited about this idea. I can't wait for it to start to show up. Tesla's China vehicle registrations totaled 19,300. The stock should be up. That's like the best month of the quarter. Strongest performance of the third quarter. The EV giant is expected to report global third quarter deliveries on Thursday, of course. Tesla stock edged lower. The last full week of the third quarter, registrations were 11.6% higher versus 17,300 the prior week, which was up from 15 the week before that. So just constantly going up each week. All good news. We have got something happens. Here we go. Tesla's China challenge. Tesla's China insurance vehicle, they ramped up the new slightly longer wheelbase variation. This is Tesla Ruddy, I think. Unfortunately, I didn't write it down. The given incremental boost to sales since delivery started, it's unclear whether limited demand or production capacity is restraining even stronger numbers. Year-to-date registrations in China are off by 6.4%. Tesla deliveries on Thursday are currently expected to come in at 447,750 is the continuing FactSet analysis. That has not changed. And that would be up 16% versus the second quarter, but down 3.3 from quarter three of last year. Nobody's up. He says that very few people have upgraded their targets. I agree with that. Very few people in the community are estimating their numbers. The 𝐿𝐴 prediction market is still at now is going up actually to 509,000 from 505,000. And Tesla deliveries, All right. With Tesla China and European registrations down versus a year earlier, the big driver for the third quarter will be the September 30th expiration, as we know. And still, U.S. Tesla demand will likely plunge in the fourth quarter. I don't know if it'll plunge. It'll be off. I think it'll be less, but not that much. And overall, I'm thinking it won't be that much overall off compared to the third quarter. And then remain weak for some time, the article says. CEO Elon Musk said that at the quarter two earnings call that we would have some rough quarters. XPeng, Xiaomi, NIO, Li Auto, and BYD will report September and third quarter deliveries early Wednesday. So that'll be tomorrow. We'll start seeing some of those coming in. We know that full self-driving is coming out this week. We haven't seen that yet. Let's see. Canaccord hiked its Tesla stock price target to $4.90 a share. Improved delivery trends. The firm's latest checks across approximately 30 countries showed stronger than expected Q3 deliveries, marking a positive break in trend after several quarters of slowing growth. Analyst highlighted Tesla's commitment to unveiling new EV models soon. We're still looking for that Model Q, Model 2, less expensive, whatever it's going to be, and help offset potential headwinds like the end of the U.S. model, the credits from the U.S. government. Energy storage growth. Here's somebody, look at this. See, Canaccord knows about energy. Canaccord cited accelerated demand from utilities and hyperscale data centers for Tesla's energy solutions, positioning as a key tailwind amid rising interest in behind-the-meter power options. TipRanks has this. HSBC, Michael Tyndall, added that Tesla's Q3 volumes also benefited from favorable tax treatment in Turkey for battery electric vehicles and the Model Y refresh. In fact, the strength in Tesla volumes in Turkey was enough to more than offset the lower volumes observed in broader Europe. However, the favorable tax treatment has since been amended, and Tyndall expects Tesla's volume growth in Turkey to ease. Further, the analyst expects that while Tesla has been seeing growth in Spain, it was mainly also due to generous incentives, which sparks doubts about the longevity of such demand in that market. So we'll see what happens there. I had Grok. There was a bunch of presidents and governors of the Fed speaking over the last couple of days. So I had Grok analyze those talks to see if there was anything that they said that we should pay attention to. And basically, no. All right, what about the housing market? We got housing prices this morning. July results reinforce that the housing market has downshifted to a much slower gear, says Nicholas Godek, who's the head of fixed income tradables and commodities at S&P Dow. National homes prices rose only 1.7 year over year, down from June's 1.99% pace, and a far cry from the double-digit gains of 2 years ago. I think that's what I said the other day, isn't it? In fact, this is one of the weakest annual price increases in the past decade, and notably it's below the 2.7% rise in consumer prices over the same period. So, in other words, what we're trying to say here is, folks, as usual, the Fed is way behind, the government is way behind. The analysis of the consumer price index is way behind, and this is 30% of the CPI. So we should be seeing drops in the CPI. In other words, U.S. home values have essentially stagnated after inflation, marking the third straight month of real housing wealth decline for homeowners. Well, that's assuming you believe the CPI. I would say that it's probably also true because 1.7 is even under the 2% that we're seeing from Truflation. This reversal is striking. During the pandemic boom, home prices were climbing far faster. Now the situation is flipped. What's keeping price growth barely in positive territory at all is the rebound we saw earlier in 2025, offsetting a soft patch in late 2024. National home prices edged down slightly last autumn, and they crept back up in the first half of this year. The net result is that July's index level is only about 1.7% higher than a year ago. Essentially, the market experienced a minor dip in recovery. Short-term price movement in July underscores the housing market's fragility. A majority of the 20 cities saw month-to-month price declines in July before seasonal adjustments, a sharp turnaround from just a few months ago when most markets were still eking out gains. The national index itself ticked down 0.2% in July, which is a softer result than the usual early summer uptick we might expect. After accounting for seasonal trends, the national index was down about 0.1%, indicating that underlying demand remains tepid. Clearly, the combination of high mortgage rates stretched by our affordability is limiting how far the spring-summer rally can go. The fact that so many metro areas are now slipping month to month, including former boom towns like Seattle, down 0.9%, Phoenix down 0.8%, suggests that the housing market is still searching for stable footing. Looking ahead, the housing market appears to be settling into a new, more measured equilibrium. Godek concluded the era of the 15 to 20% annual price increases is over. While that means homeowners aren't gaining wealth at the breakneck pace of a recent past, it also signals a potentially healthier trajectory for housing in the long run. Prices that grow in line with incomes and consumer prices are more sustainable, reduce the risk of the kind of affordability crisis and speculative bubbles that we've seen before. Oh yeah, by the way, again, I need to say it again. The out-migration is impacting this. I know you say, oh, these people don't buy homes. It's one market. Okay, as rents come down, people that were planning to buy don't buy. The ongoing rotation in regional performance is another sign of normalization. Markets with strong local economies and reasonable prices are doing better than those that overshot fundamentals. In short, the housing market's post-boom era is one of stability over sizzle, a shift that may feel disappointing to sellers used to huge gains, but ultimately creates a more balanced future. All right, the Chicago business. So that was super good news for the economy in general. Maybe you say, well, but not for me as a homeowner. Well, okay, you've had your run up. This is what President Trump is promising, is that assets and Wall Street have had their run. It's time for Main Street and the low end of the what you would call the working poor and the middle class wage earners to have their day, and that's what we're going to have right now. The Chicago Business Barometer produced, slowed 5.6 points to 41.5 in August. That's a much bigger slowdown than they expected. That has been below 50 for 21 consecutive months. The decline was driven by a sharp pullback in new orders, along also falls in employment, production, and order backlogs. Was offset by a rise in supplier deliveries. New orders dropped 10.8 points. Largest fall since September of 2023 was driven by a decrease in the proportion of respondents reporting that they knew there was a drop in respondents reporting new orders, increase in the proportion of reporting fewer new orders. Employment compressed 5.9 points, 5.9 points. So that would be something the Fed would be looking at. The indexes, maybe that's why they're saying they're starting to see softness. This is the first one that I've really seen showing this kind of softness. The index is now more than unwound the 8.3 increase in May. So this could be remember, this is a survey. Production softened 3.6 points, weakest level since December. Order backlogs eased 1.4%, and prices paid, though, contracted 8.3 points for the second consecutive month. It remains above the 2024 average, but the price increases are not happening, at least according to this survey. And we always have to keep in mind that these are surveys. All right, what about the JOLTS? The JOLTS index, are the job openings decreasing, increasing? Well, as I said the other day, the number of job openings was unchanged at 7.2 million in August. Over the month, both hires and total separations were little changed at 5.1 million. Within separations, both quits, 3.1 million, and layoffs, discharge, 1.7, little change. So the Chicago numbers showed some decrease in the job situation, but this is showing flatness. And flatness is exactly what I would be expecting right now, which is what I said on Sunday night. The Conference Board Consumer Confidence Index. Now, this is big because I actually still trust these guys, but declined by 3.6 points in September to 94.2. The present situation index, based as consumers' assessment of current business and labor market conditions, fell by 7 points to 125.4. The expectations index, which you can understand what that means, decreased by 1.3%. Expectations have been below the threshold of 80 that typically signals a recession ahead since February 2025. Well, but the recession hasn't come. In fact, we know that the GDP now thing is at 3.9. Now I don't have to say that later. The cutoff date for preliminary results was September 21, 2025. So consumer confidence weakened in September, declining to the lowest level since April of 2025, just a few months ago. According to Stephanie Gouchard, senior economist. The present situation component registers its largest drop in a year. Consumers' assessment of business conditions was much less positive, while their appraisal of current job availability fell for the ninth straight month to reach a new multi-year low. This is consistent with the decline in job openings, but we just saw job openings are stable. Expectations also weakened in September, but to a lesser extent. Consumers were a bit more pessimistic about future job availability and future business conditions, but optimism about future income increased, which would be, again, this is a survey, and that would be in keeping with what's actually happening, which is that real wages are increasing. Among demographic groups, confidence rose more for consumers under 35, but declined for consumers over 35. I don't know what's causing that. The evolution of confidence by income group was mixed, no clear pattern. To those making for all consumer by income, confidence remained above its April low for all consumer cohorts. By partisan affiliation, confidence improved slightly among Republicans and Democrats, but dropped substantially among independents. Now, that's when you look at something like that, you go, okay, there's something wrong. If you're doing statistical analysis, you look at this and you go, why would it drop among both Republicans and Democrats? I'm sorry, be up above both Republican, people that are partisan, but be down dramatically among independents. You would say there might be something wrong with my numbers. �伊𝐸𝐴𝐵 added, consumer write-in responses showed that references to prices and inflation rose in September, regaining its top position as the main topic influencing consumers' views of the economy, even as clearly under every single analysis, prices are stabilizing or going down. References to tariffs declined, but remained elevated and continue to be associated. So this is basically headline reading. This is what I really think. That's what I really think about this consumer confidence and consumer, what's the other one called? Anyway, sentiment. Those two indices, I think they're headline reading. Nonetheless, consumers' average 12-month inflation expectations inched down. Listen to this now, inched down to 5.8%. This is so out of whack that it just throws off your confidence in the entire confidence index. 2.0 is what Truflation says the inflation rate is right now, 1.9 year over year. The president's sitting at 4.9% approval rating today, and that is the news. Now let's look at where stocks are. So Tesla has settled into just about 1% down at $438.84. The Dow is sitting at 0.16 down. The NASDAQ is down 0.15, and the S&P is down 0.09. So all of those, I don't think they're waiting on the results of the shutdown. And remember, if there is a shutdown tonight, and if the shutdown continues through Friday, we won't get jobs numbers, but we will still get the job numbers from ADP tomorrow. So I think it's looking like we're getting into kind of a wait and see situation here, very flat market. Tesla, very much where I expected it to be right now. If you'll remember what I said all last week, I thought we would be inching up, and we did inch up. We went even above the number that I thought we would go. I thought we would stay at 440. Right this morning, we're at 439. So this is kind of very much what I expected. We have got the Magnificent Seven all down, except for NVIDIA is actually up 2.2 this morning. So if you watched last night, Larry said he was probably going to buy some NVIDIA. I hope he bought early. So VIX, we got the VIX is up a little this morning, but headed down. We're still sitting around 16, which is where it's been. And we've got the Cathie Woods mix this morning, mostly down, but a couple of them are up. But if we go over to my favorite, the number one thing, we have Trump says that Pfizer, this is headline breaking news, Trump says Pfizer is going to announce agreement to lower drug prices. That should be extremely good news. All right, let's look at the bonds. We have got, I already looked this up earlier, down another 2.7. We're in a major bond rally, down 2.7 basis points to 411.5, 4.115. This is where we were just a week ago before that weird uptick. I told you it was a weird uptick. Again, I said we would stay below 4.15. And we are going to do that. I think we're headed down into the threes, as you know. We've got oil now falling this morning back to 62.57 as OPEC is adding more capacity or more production rather. Natural gas up a little. Natural gas been going up straight like this for the last few days. 3.3 this morning. Gold is up another 24.70. That's got to be another record high, 3,879. So we're approaching 3,900 at this point. Maybe we go to 4,000 and we hit 4,000 and then that's it. This cannot go on forever, I think. I'm not making that call, but it seems like we've potentially stretched this as far as it should go. Silver is down a little bit this morning, down 0.5, and copper is also off this morning, but it's sitting at $4.86. The dollar is mixed. Bitcoin falling off after recent gains, down 1,000, down to 113,000. And those are the numbers we got later on today. Nick Gibbs is still off because why? Oh, yeah, he had a baby. Well, his wife did. And they're having a great time with that young baby. Everybody's good. Mother and baby are doing fine. Hopefully, Nick will be back next week. I don't know, but he's just kind of busy right now. So we'll have Brian Wang on tonight. So he'll be 2 nights in a row, Tuesday and Wednesday. That's a good thing. Not that Nick being gone is a good. Anyway, you get what I'm trying to say. And then after that, it'll be Brian White. Although I think we're going to have a Brian White in the middle of the day too, because I messed up last night. The game was so cool. No, it wasn't. It was horrible. It was a runaway. But anyway, somehow I forgot to put up Brian White's video last night. I think I'm going to put it up midday, and then Nick Gibbs, and then Brian White later. At 7 o'clock, 7:45, something like that. Now, did I say Nick Gibbs? I mean Brian Wang. So lots of Brian today. Brian. So that'll be fun. And let's go back and see if there's any movement in the last 7 seconds on Tesla, because we just do that. Yes, it's still down just a little bit more than it was a minute ago, but nothing significant. Okay, that's all I got for you right now. That's my call. Continues to be my call. If we hit 470 or more, and if we get to 12 or 13 or more on the deployments, then Tesla will be up back into maybe that 450 that we hit the other day, 451, certainly to the 444, 445, but potentially we go back up to that level, and then we would continue to move up higher and higher towards earnings, because if we hit over 470 and over 13, then that's going to be much higher earnings than the street currently predicts. Okay, that's my current call. That's all I got for you right now. It's been great talking to you.